Hello, everyone, and welcome to this week's SelfWealth Live. My name's Owen Rask, and I'm thrilled to have you with me this week. Don't forget, if you want to ask me a question, you can do that. You can just jump into the YouTube chat function there, and you can fire away your investing questions. Give me a thumbs up or say g'day so I know you can hear me, and we'll go from there. I'm just dropping a question I'm just saying hello into the chat feature so you can say g'day back to me there if you like. I can see that there are a few of us already here waiting to talk investing, which is fantastic. So today we've got a pretty full-on lineup. We're going to jump into a different screen. We're going to, hey Cameron, good to see you. Today we're going to jump onto some different stocks. We're going to talk about an ETF that I own. We're actually going to talk about another company that I own too, which has just reported results today. And then, of course, last week you will remember that we were going to get to a real-life discounted cash flow analysis, so how analysts actually value stocks. We're going to just do a quick recap on that today because I've got the screen good to go. So we had some technical difficulties last week. Hopefully this week it's all smooth sailing. Cool. Okay, so this week what we've got is a few different companies. Last week we talked about different. We talked about an ASX listed company. We talked about a Tomos, which was a small company under the ASX ticker symbol AMS. So we've got a bit of a delay here. So what I'm going to do is I'm just going to wiggle something around just on my end. Okay. And if that gets better or worse, just let me know, guys. The other thing, we're going to jump into some screen sharing in just a moment too. So we'll be able to move past that pretty quick. As just a brief recap of who I am, my name's Owen Rask. I'm the founder of a company called Rask Australia based here in Melbourne. Working from home today, just out in the Dandenong Ranges. I've got the trees over the back here that I'm just looking at. I'm delighted to be working with SelfWealth to bring you 60 minutes of live discussion every week where we can answer your questions. So if you want to ask me questions, ask me investing questions. If you have questions about your account or about features, the best way to do that is to head to selfwealth.com.au and then you'll find the support function, the little chat widget down in the bottom corner. From there, you can talk about everything to do with your accounts as well as feature requests and those types of things. So there's a little feature there under the support menu there, you'll see that. So you can also use, to get in contact with us, you can also use the hashtag SelfWealthLive on any social media platform. Okay, so the other thing that I wanted to talk to you about today is just that if I do answer any of your questions, there's going to be a big fat disclaimer there that says, this is general financial advice only. I'm only permitted to give general financial advice, not personal financial advice over a live stream like this. So that means if I do talk about any investing concepts, you will need to seek the advice of a financial professional, such as a financial advisor, before you act on the information. And as always, past performance is no guarantee of future performance. Okay, so I can see that there's a slight audio lag. Really, really cool that it's not perfect, obviously not very cool at all, but I'm going to jump into straight up into some stock analysis with you because I've got a lot to get through as we go through, ask the question, and we'll go from there. Okay, here we go. So we're going to jump across into the screen. I know there's been a few issues here, so let me know if there's a little bit more of a lag and we can try and work on that on our end. So, okay, just if you can see here, this is a company called Nanosonics. This is a business that we talked about a little bit last week. They reported results. The shares jumped about 20%, which was a bit, it was bittersweet for us because we said to our members, we said, we think this company is, probably fully valued at this share price, so therefore we're not buying it. But you can see here, and I'm just going to be quick. If you have any questions on this, just jump in. You can see here that this is our discounted cash flow analysis. So this is the way that most fundamental investors value stocks. Well, screen share works. Yes, it does, Vico. And so here, for those of you who don't remember, Nanosonics sells components and devices that are kind of like microwaves for ultrasound probes. You can disinfect an ultrasound probe in a matter of minutes and then go from there. We'll just get rid of that. Sorry about my notifications. As from another investor. We'll disable that till this evening. And so here we can see that, zoom in, yep, sure, here we go. 50 inch, so plant one, you're on a 50 inch and just see the figures. What kind of screen are you using? Wonderful. Okay, so here we can see that the number of units installed throughout Nanosonics marketplaces. We've got North America, Europe, Asia Pacific, and the rest of the world. And we can see the total number of installed units. And these are the actual units. Think of them like big microwaves that go in hospitals and disinfect ultrasound probes. Nanosonics makes money based on selling these things, which you can see down here. So what we've done here is we've calculated the revenue, the capital revenue from every sale that it makes here. And then what we can see is this line item here called Consumables Revenue. And what this actually does is this actually represents the ongoing income that Nanosonics receives from selling devices and then selling all the materials that goes with those devices. So what happens is Nanosonics sells the unit into the hospital and then provides ongoing maintenance, like services revenue down the bottom here, but they also sell things like fluids and that sort of stuff. And you can see how this is kind of made up here in the final shakeout for 2021. If we drop down, all of this revenue that we calculate up the top here, most DCFs start like this. They start with, okay, what parts of the business do we need to model? And then they drop down into revenue at the top line here. And then from there, you can see that we drop down into basically an income statement. So for those of you who don't know, the income statement is typically the first one in an annual report. So Sly Meat from the Shed says some info on Altium's demise today would be good. Yeah, we'll take a look at that in just a second. And so I just wanted to recap this here. You can see how we kind of make up a discounted cash flow analysis, or DCF. So this is different to, say, like price earnings ratios that you would see in your SelfWealth account, which we'll get to in just a moment. Finally, we rebuild the income statement and we get down to profit down the bottom here. From there, we jump into something called the free cash flow model. So free cash flow to firm. And you can see here, we have to adjust from profit down to cash flows. And I'm just skipping over the top here. If we come right down, we can get to a valuation for Nanosonics. Now, I don't want this to scare you off it, because if we jump back into here, what we can see in the SelfWealth account, what we can see here is Nanosonics' share price is currently $6.68. And you can see here that our valuations are substantially below that. But that's because we've been playing around with the model a bit to see what it would take to get to a Nanosonics fair value. Can we get a copy of the DCF, Chanda? Well, I'll follow you up on that one. We'll check with the SelfWealth guys to see that they're comfortable, and we might be able to do another follow-up next week. But basically, what I wanted to show you here, guys, is the way an analyst thinks when they're talking about fundamental investing, in terms of, we get all the numbers from the annual reports, we pop them in, and then on the day, typically on the day or the day after the company releases its results, what we'll do is we'll go in and we'll fill out the latest numbers and check our forecasts against those numbers to determine how accurate we really were. And so then we come down and we get to an updated valuation. And the point I'm trying to make here is that when we do our research, we want to do these things before we get the results. So Nanosonics reported last week, we did this about a month beforehand. So you want to do this before you get the results, so that on the day you know what to expect. Okay, so that is just a recap of what we missed out on last week because of some technical difficulties. The great question before from Slimy, who asked, Altium is down 10%. It's the demise of Altium. I've actually gone into, I've been in SelfWealth on the platform this morning. So why don't we jump in here? Let's go to Altium. So for those of you who don't know, Altium, what does Altium do? Well, Altium is a technology business listed right here in Australia. And if we come down to the overview page here, we can see basically what it does. But I'll give you my definition. This is a great definition here, but $4.5 billion company. Altium creates the software that allows designers and engineers to create something called a printed circuit board. So just like any of the devices that I have around here with me today, so say like a good one would be this device. This is a recorder for podcasting. This is what we use. And within this, you would actually find, if you pulled it apart, you would actually find that there's a green or a blue board typically in there. And that's what we call a printed circuit board. A machine makes that in a factory, and it puts little connections on there and what have you. And Altium actually creates the software that designers use to create this. So not the actual board itself, but the software that designers would use for that. And Altium's business is split across a few different kind of segments, which we'll get to in just a minute. But you can see that here its products include Altium 365, which is its new cloud-based product, Altium Nexa, which connects everything, Altium Nexus, which is for enterprises, Altium Designer, and Altium Circuit Maker. So these are just some of the business products, but there are some other parts within Altium that I find really appealing, such as its Octopart business, which we'll get to in just a moment. And today the company's come out and it's reported some results. So I'm just going to jump into those. I've already preloaded these. So here we can see the annual report. We've got the media release, and we can see the presentation. I'm going to take each of these one by one, and as we go, you can ask some questions. Great one from Slimey again. What are your thoughts on AXE? I really like it. Quantum computing. Yay. Now, I'm not the guy to talk to about quantum computing. I'm sure there's someone smarter out there than me, but I actually listened to a fantastic podcast on the weekend by the team at Seven Investing. This is a US-based podcast. Seven Investing interviewed a CEO who's at the forefront of quantum computing. Sounds like the next 5 years are going to revolutionize our computing experience, not here on the desktop, but definitely at the server level and cloud compute level. Quantum computing is a very big deal to come down the pike. So I'm going to just quickly throw some things at you guys, and if you have any questions, please bring them on. One of the things that I'm going to explain today is around Altium's business, generally speaking, and also about the way results are communicated generally to investors like us. So Vico asked, what sector is booming? Well, that was quantum computing, Vico. So if you want to know, you can go find out more about that. There are many companies that are in this realm, quantum computing. Yeah, Chris, that's right. Altium dropped 11% today, and we're about to discover why. I hope we can dig into some of those results. So here we go. Typically what happens when a company releases on the ASX, and you can find all of the releases on the news and announcements tab here on the Altium page. What I like to do is click price sensitive only, and then you will see all of the results that have come through from the company. And you can see the exclamation mark here to signify the company's updates. But one of the things that I might just throw at you guys today is, if you did this, if you just click price sensitive and all news type, you would actually miss the annual report that was released today, because Altium released it and they didn't mark it as price sensitive. Instead, they gave us this preliminary 4E, which was only 2 pages long. So sometimes when you click price sensitive, depending on what the company does, you might miss it. So if we come across into the media release, which is like sometimes the first thing that I look at, but it's not always super reliable. I might actually just turn off my camera here for a sec, just so you guys don't have to watch me for a second, just like that. So here we can see that Altium says we've got strong growth in annual recurring revenue of 29%, recurring revenue up 65% from 59%, second half continuing business revenue of 16%, strong cloud adoption here with Altium 365, record revenue from Octopart. So what's Octopart? Imagine you're inside a piece of software and you're trying to find a part. So you're designing this wonderful new iPhone, and you need to find the little widget that connects the camera sensor to the screen, for example, as a simplified example. Octopart is a built-in search engine, kind of like Google for printed circuit board designers. And what happens is, within Altium software itself, you can search for parts that you might need, and you can buy those parts. So I think if we go like this, we can see what the business does. So we can actually search. This is an Altium business, And we can actually sit. So let's say we go for integrated circuits. We want something like a data converter, analog to digital. And let's just say we want it from Texture Instruments, which is a US-based company. And you can see here, if you want to buy, say, this thing, which is ADS 83251BDGKT, you can actually buy, see what's in stock, and you can buy it directly through Octopart. If you buy one, it's $11.29. But if you buy 10,000, you can get a slight discount. And basically, the point is that you can use Octopart to buy components for your whatever it is. And so we can see some strong growth here. We've got a partially franked dividend, I should say, up 3% year over year. And so further down here, we can see a highlighted example. Now, if you just read this, if you just read the dot points here, you would think that this report and what Altium has achieved is spectacular, right? Because you've just gone dot points, wonderful, yep, great. Looks like there's some percentages, great. But you actually come down and you can see that the company has divided a lot of things and chosen to be quite selective in how it reports results. So here we can see the actual revenue only went up 1%. They actually divested a business called Tasking a few months ago. So they've tried to exclude that for us, which is good. But you can see the margin has actually come down here, the Ebitda margin, earnings before interest and tax. So obviously you want to see a wider margin, not a thinner one. So that coming down is actually a concern. Further down, we can see that Ebitda, if we just take Ebitda as it is, it's actually fallen 3%. And net profit after tax, while it's gone up, continuing EBS is up 78% as well. There's a bit of a kind of like a mismatch here. You can see profit before tax down 7%. So this result was actually quite, what I would say is quite mixed. And if we come down the bottom here, we want to, in my opinion, we want to look at full year results, not comparing half years and what have you. Even though they sold their business, we want to still look at the full year impact. And we can see here that Altium does a lot of its business in Americas. So, North America, Canada, USA, etc. And what we can see is that for its board and systems product, revenue actually fell. So this is something that I imagine would have spooked the market. We can see Chinese revenue is coming back on board after COVID, up 11%. Rest of world also up 19%, but that's a smaller part of the business. Octopart, which is the one that I just referenced, this one, the actual sourcing of products for manufacturing and for design was up 42%. What's really interesting about this, and I'll get back to some of the questions here from, say, Ad Astra, who asks about what ETF has sustainable growth but small distributions, i.e. good to invest in on behalf of a miner. I'll get to that question in just a second. But what we can see here, and why I like this metric right here, is that if you think about it, when you're designing something, you are going to be going out and buying things and putting those into your product. And so this is part of Altium's big push away from just being a design platform to actually also connecting designers to a manufacturing site. So imagine being able to design and then with a click of a button, send that to a manufacturing site to be created. That's basically the Altium vision. The one thing that I'll also pull out at the top here is probably the biggest explanation, Slimey, of why shares might be down when we look at Altium up here. The big reason is they say, due to unforeseen delays in the finalization of our annual audit process, amplified by the impact of the COVID-19 pandemic in New South Wales, the release of Altium's audited results has been delayed. Altium expects the audit process to be completed and its audited results to be released within a week. So what I want to just point out here is this is not normal behavior for a company. This is not normal. Altium does not expect there to be any material difference between today's release of unaudited financial statements and the audited financial statements to be released shortly. So that's reassuring. But I was actually chatting to someone in our team today who is an auditor, and what he said was that it doesn't make sense. It doesn't make sense that there would be such a delay because they'd already expected to release their results earlier in the month, and then they delayed it to today, and then now they're saying we still don't have the audited accounts. Now, I'm going to give the company some credit here because they actually did divest one part of their business, which is called Tasking, earlier in the year. So maybe they're just struggling to get all of the numbers together. On the analyst call and investor call that I listened to this morning, which, by the way, for those who don't know, you can typically find at the bottom of a media release like this. You can just click on here and register. So you just go into SelfWealth, find the media release, and then click on this link. Anyone can register and listen to what the Grand Chiefs have to say down here, based in the US. They said, but I know Aram, who's the CEO, I believe, is based in Sydney. So if we come into the annual report, this is the last kind of thing I want to talk about on Altium. There's one more thing after this, but I want to tell you guys about a quick hack that I use when I look at annual reports. So if we go down and I'm just using Command F here. I'm on a Mac, but you can use, I think it's Control F, and you can search through the annual report for the business segments. So the segment reporting is actually, I think it's under IFRS 8. This is a requirement for chief financial officers to include in annual reports. And what you can see here is an explanation of what the business does. So some people really, really like this. I know some investors that love this section because it actually shows them what's going on underneath the hood. People need to think of where Altium will be in 5 years rather than getting overly concerned about a COVID-related delay in audited. That's from Slymeat. Love the name, by the way. Slymeat from the shed. Love it. Yeah, and I agree with you, Slymeat. That's exactly what I think. Altium, if you're investing in Altium today, you're investing for 5 years, which I'll get to, which is the final point. But just on this segment report, this is something that our analyst team always uses when we look at companies. So we drop down further, and we can see here the different parts of the business that are generating revenue. And if we keep going down, we can actually see which markets too. And so then we can put this back into our spreadsheet. Remember how I talked about the Nanosonics one over here? So if you wanted to start creating your own model for Altium, you could start by creating these line items here, then filling in 2021, and you'll also have 2020 if we come back in here. And so you can see the revenue generated in the Americas segment was this, this, and this. And so here you can see, and there's a great reminder in there, guys, that anything that I talk about today is limited to general financial advice. I've got to mention that again. So here we can see the revenue from the different segments of Altium's business. And if we go down a little bit further, we can see the same thing from last year. So you can use these in your modeling going forward. Altium also provides another note in the accounting statements to break down the different types of revenue that it earns from its customers. So again, really, really interesting, and it's a way to help you forecast your numbers. All right, to Slymeat's point, I'm going to jump across one final thing into the this part of the release today, which was the presentation. And the thing that was really reassuring for me for Altium was this chart right here, number 6, page number 6 in my thing up the top here. You can see this has been Altium's journey over the past 5 years or a bit longer. So you can see right back to 2012, the business has been rebuilding, performing, leading. These are their words. And the next stage is what's interesting. So what's interesting to note about Altium is that in the past, Altium software was predominantly focused on the desktop. So, I'm recording here on a Mac today. I could use Altium software right here on my iMac. But in the future, and currently, what Altium is doing is pushing people into the cloud, the 365 model. And that's where we get the thing called annualized recurring revenue. So you can see that here, annualized recurring revenue, and you can see this yellow line creeping up in the back here. Management made this a big focus for today, and you can see $136 million in annualized recurring revenue. They said that on the investor call this morning, they said that some of the issues they had last year are not repeating this year with COVID, which is great news. So, okay, so you can see in FY22, just one final thing on Altium, they've actually guided for a bit more growth. One thing I'll say, guys, is that before you go believing management, make sure you do your own work. Take into account the track record of what's happened in the past to make sure that if management says something, they're actually going to do it. There's talk of an acquisition coming up, which should boost some of these metrics here. But always, always, always do your own work and just don't take management's words for it. Okay, so that's that. Looks like we've had a few people ask about Dicker Data, DDR. Not a business that I follow that closely, but we can get to that in just a second. There was a great question here that comes through. And here, where was it? Ad Astra asks, what ETF has sustainable growth but small distributions to invest? Good to invest on behalf of a miner. So that's a great question. We're going to actually talk about an ETF, and this is an ETF that I own, and it's actually really interesting because I went into SelfWealth this morning, and this is the ETF. It's called MOAT, M-O-A-T. By the way, in summary, I own Altium shares, but I also own units in this ETF here. So you can find out all about this ETF here. It's MOAT, M-O-A-T. And the MOAT ETF, you can find out if you come down the bottom here. This is a really interesting insight that we can see on SelfWealth. And I don't know if you can get this anywhere else. It shows that most people who buy the MOAT ETF, around 48% of people, say that they're buying this ETF because they want to align it with a target portfolio. And this is actually something that I wanted to talk to you about today, which is how do you build a core and a satellite portfolio? The reasons that people sell are because they have a better investment idea, they're taking profits, they're aligning with the target portfolio, etc. So this one here on the left-hand side, aligning with the target portfolio, and this one here, which is the third one, actually the same thing. It's just aligning in a different way. So this one might be adding to the position, and this one down here might be taking some chips off the table. So what does the MOAT ETF do? Well, you can find out more on this page, but I would encourage you to actually go to the Etf Issuers Page. And so Ad Astra, this is an ETF you might want to put on your watch list. So it's actually operated by VanEck. You can see here, VanEck. An important note with ETFs in Australia, guys, is that the first name that appears inside the SelfWealth brokerage account, so in this case, VanEck, is the name of the ETF issuer, whereas the next one, which is this one here, is typically the name of the index provider or the joint venture partner. So this means that it's run by VanEck. So we'll go to VanEck's website just quickly. Here we will find a description of what the MOAT does. So the MOAT ETF gives investors exposure to a diversified portfolio of attractively priced US companies with sustainable competitive advantages, according to Morningstar's equity research team. MOAT aims to provide investment returns before fees and other costs which track the performance of the index. And the index is Morningstar's Wide Moat Focus NR index. So if anyone has any questions on this, so Warrior, you've got a 0.49% management fee. Is that good? So you've got some sharp eyes on you today, friend. You've said here, management fees are around about 0.49%. So when our team pulled the numbers for the entire ETF industry in Australia, what we found was that the average fee is around about 0.5%. So that's across all ETFs, regardless of sector and type. That's the kind of average there. So it's actually not that bad, I would say. At 0.549%, I mean, I own this ETF, and this is an ETF we've recommended in the past to our members. So, and I still own it, so I'm comfortable with it. But the key is that, remember, guys, that I was listening to a really interesting podcast on the weekend, and remember the important thing is when you have a management fee, sometimes it's good to pay up for good quality investments. So, we know that ETFs like the Ebitda shares A200 ETF, which is another ETF that I own, by the way, full disclosure, is 0.07% per year. But that's not really comparable with this ETF because this ETF does something different. So you need to understand what you're getting. And so if we come down, we can just, if we wanted to, we could just buy this ETF right here or add it to our watch list inside SelfWealth. So you could buy it just by clicking this button, or you could add it to your watch list. And what you'd actually find is that you'll see that when you buy into the MOAT ETF, it actually gets you exposure to a good list of US shares here. So we can see the top 10 here listed on the VanEck website. We've got companies like Alphabet, which is Google. We've got Microsoft in there. We've got Facebook. We've got Medtronic, Salesforce, Wells Fargo, which is a big US bank. So these are all US companies, and you can see that by the ticker code here. So this is an interesting ETF because the reason why I quite like this ETF for a watch list position is that the Van Eck ETF combines what we know as like ETF investing, which is like kind of like by the rules, but it combines that with the research of US investors from Morningstar. So the Morningstar equity research team. And what you get is you get ETF investors, sorry, not ETF investors, you get Morningstar's team in the US providing research and valuations on US stocks combined with companies that have wide moats. So wide moats, think of a moat as the ring of water around a castle. A moat, which comes from Warren Buffett and Ben Graham before him, actually says that companies which have a competitive advantage or moat will perform better over the long term. So companies like Microsoft, which owns Microsoft Office, which has Azure, the cloud computing, it has Office 365. It's a very sticky, defensible business. Therefore, it has a wide moat. When a company has a wide moat and it looks like compelling value for the analysts at Morningstar, it goes on the list to get in the portfolio. And that's kind of how it works. Gemma says, I'd like a wide moat. Yes, wide moats are the best kind of moats. So wide moats versus narrow moats versus, I guess, no moat at all. So Facebook is a good example of a business that has a moat because it's got over 3 billion users across Facebook, Messenger, Instagram, which it owns, and WhatsApp, which it also owns. It's a pretty strong business. So obviously the investors at Morningstar say that Facebook has a wide moat. So that's a really interesting business right there. And so if we come back out of this, so the question from Ad Astra was, well, what about, keeping the turnover low? I don't want to pay lots of tax because I'm investing on behalf of a minor. Now, I would say that the important thing here is that chances are moat is not the ideal ETF for someone who is looking for an ETF that's not going to have a lot of turnover. So what do I mean? Let me just unpack that a bit. Inside of an ETF, you will find a number of shares. So here you can see that there's 10. These are just the top 10. They're not all of the shares. There's actually 48 in total. Let me zoom in on that. So here you can see that there are 48 ETFs, 48 individual stocks inside the Moat ETF. And what you'll find with the Moat ETF, or at least what I've found, is that because these stocks are chosen based on valuation and the Moat rating from the analyst team, what tends to happen is there are two reasons that one of these stocks could be kicked out of the portfolio. One could be valuation, and the other one because the analysts changed their Moat rating. So what I want to keep you at front of mind, for you to keep at front of mind, is that 48 positions is not a lot. And also, so that means if one of the positions comes out, that could be up to 2.9% of the portfolio. And if the Moat rating or valuation changes, they will also be removed. So this one has a lot of turnover. And turnover, the buying and selling inside an ETF, creates capital gains and other types of tax events. So another ETF that you might want to look at might be just the simple IVV ETF. So here we can see IVV, many of you will know, is the S&P 500 ETF, and it has around about 500 positions in the ETF at any one time. It's got pretty low fees. It's one of the biggest ETFs in Australia. And so if we come down to the community ranking, it's actually the 17th largest, which is great. So here we go. We've got aligning with the target portfolio as the number one reason to buy it. And we can see that the reasons you wouldn't is aligning with the portfolio and taking profits. I think that's a very healthy skew. So Darren Pereira asks, I'm looking for a small/mid-cap index ETF to complement my VTS holdings. Okay, really interesting. I'll try and answer that in a second. Mwanza Achuka says, would it be fair to say that when buying US ETFs, the best time to buy would be around 12 to 3 p.m.? And I think the reason that you're saying that is during the trading day, Mwanza. So what actually happens is when an ETF like the iShares S&P 500 ETF, when you buy that, let's say you go into market depth down here. This shows you the number of sellers in the ETF and the number of buyers. So if you put in an order, you would be one of these buyers, right? Now, what actually happens is this here, what you see here, this in investing language is called the liquidity or depth on the screen. So remember that, on the screen. And what this shows you is you can literally see on your screen the number of sellers at certain price points, right? And here you can see that the difference between $618.23, $618.24, $618.27 is actually very small. So it's very, what we call very tight. So the spread or the liquidity is very tight. Now that's a really good thing. In the past, and I think this is what Mwanza Achuk is talking about, is in the past, what actually happened is if you invested in an Australian ETF that invests in US stocks, there might be a bigger spread here. So meaning the difference between the prices is actually quite large. And the reason is that when you buy into an ETF, a company stands on the other side of that transaction, for often, not always, and they take your money and they go and invest the money that you give them, they invest that in the US stocks that go in the ETF, and then you get the units in the ETF showing up in your brokerage account. You get to see this in your brokerage account. Now, today, more than likely, it's important to know that this is not necessarily a bad thing. So you could probably place an order during the middle of the trading day, as you say, and it's a really interesting way to go about it. So I would say between 12 and 3 is perfectly fine. That's when I buy my Moat ETF. That's when I tend to do it. But there's no real hard and fast rule these days because everything's pretty well taken care of. Another thing that you can do, which I really want to talk to you guys about, is if you like, say, the Moat ETF here, right? This is a really interesting insider hack for you. If you like the Moat ETF here, you can see what shares are inside it. So which companies are inside it, and you can put these companies on your watch list inside SelfWealth. So let's say you want to investigate Alphabet, which is the owner of Google. You can come in here, and if you see here in my demo account that I'd have to activate US trading, but you can add that to your watch list. Done, just bang, just like that. And if you had US trading, you could buy it right here. And so you can actually use an ETF like VanEck's Moat ETF to shortlist your watch list, which is something that I do. Another one that I might do is, let's say if you look at an ETF like, say, I don't know, what's a good one? Like, let's say Clean Energy, the new one from BetaShares, CLEN. See if we've got that here. This is a new ETF, sorry, from VanEck. The Earth one is from BetaShares. So if we come up here, we can try and find Clean. Where are we? Here we go. So this is an ETF that invests in sustainable companies, or companies focused on sustainability. So here we can see Sunrun Inc. is a company that's up on their list. This is not a company that I own. Or First Solar. So FSLR. Let's have a look at that company here. FSLR. And we can see First Solar is here. If you're interested in companies, let's say you want to create a watch list because you want to take more ethical investing into account, or sustainability focused investing, you could create a watch list called sustainability, and you can add this company straight to your watch list for further research. It's such an easy way to do it. So yeah, we've actually just put a poll in the chat, guys. Anyone that wants to request that I cover a company in depth next week, so we're going to go really in depth into one company, a really fast growing company, just pop your vote in there, and we'll be able to jump into the platform. So we can see here that already Apple, Apple Inc., which you all know, is a company that is obviously leading the world in computing and smartphones and health and those types of things. That's already polling really well. What else is polling really well so far? Let's have a look. So it's actually Apple and Amazon that are tied for number one. So if you want to jump in the chat, let us know what you really want us to cover, and next week we're going to do it. we're going to cover one of those companies in great depth. So jump in the chat, let us know what you think. Amazon has just taken the lead, everyone. I don't mean to alarm you, but it looks like if you want me to cover, Netflix is now up there. So if you want me to cover any one of those companies, jump in the chat and let us know. Okay, we're going to have a quick look because this has been brought up a few times. Colin O'Toole is talking about Vulcan Energy, VUL. Let's have a look. So, and Tesla, David Martin. Yeah, I think Tesla's maybe something we can cover in the next few weeks. Maybe not straight away, like as in after the FANG stocks. So Netflix, if we also talk about The Mandalorian, this is the way. Stevie, great comment. You have spoken, you might say, for anyone that has seen The Mandalorian, you have spoken. Says Tesla, please. Yeah, a great one. So, okay, let's just have a quick look at Vulcan. So Vulcan's not a business that I'm intimately familiar with, but let's just have a quick look. So Vulcan here, we can see it's up 7%. Obviously, there's been a few people trading it today. So let's just have a look. Vulcan Energy Resources is an Australia-based energy metals exploration company. The company is engaged in developing a combined geothermal and lithium extraction project in the Upper Rhine Valley of Germany. The company's zero-carbon lithium extraction process uses renewable geothermal energy to power the lithium extraction process and create a renewable energy byproduct. Sounds fascinating. Okay, so coming further down here, we can see that it's 75th by ownership in the community. That's really high. Out of 2,100 companies on the ASX, that's really interesting. So really interesting there, guys. So there, let's have a look. Stock is undervalued. A lot of people saying that it's undervalued. I don't know. This is not don't take my word for it. This is what the community is saying. Let's have a look at the community sentiment in a little bit more detail. So we can see here there's some interesting forecasts for earnings per share. It looks like it's not going to be profitable at the earnings per share level, but our revenue is looking up. So we can see from Refinitiv, here we go, we've got target prices pretty high up, $15 compared to the current share price of $13.90. We can see a nice chart here, the scores across each of the things. So it gets a really high risk rating or I should say a low risk rating, which may not be great, but let's just toggle over that there. So the risk rating is derived by looking at a series of long-term and short-term stock performance measures, including volatility, magnitude of returns, beta, correlation, etc. Each factor is equally weighted. So these are just some quick bullet points you can get from Refinitiv. I don't need to know anything about Vulcan Resources to know that it would probably be more volatile, simply because it's involved in mining and exploration and those types of things. So if that's the case, typically these businesses can be very highly volatile depending on results or certain outcomes that come along the way in terms of like developments of projects and what have you. So we can see here, just from looking just purely at the chart here, that it's actually been very strongly on an upwards trajectory. So fascinating stuff. What else have we got here? So let's have a look at the first thing that I would look at it for a company like this, if we come into the financial section, is I would actually look at things like cash from operating activities. So cash from operating activities actually shows you, is the company generating cash, actual cold hard cash from its business model. So this is often called net cash from operating activities, or net operating cash flows has actually gone down. Now there might be a perfectly legitimate reason for that, but that's one thing to keep in mind. Let's jump into some announcements and let's see what's been announced. So we can see that there was looks like a feasibility study. BNP Paribas appointed as financial advisor toward financing the zero carbon lithium project. Okay, so this is the one which is a really interesting one overseas. I would say, now I don't know anything about this and we're not going to have enough time to go into it in great depth today, but it's a fantastic case study for what I'm about to talk about next. Is I think it's next week actually. Next week in the program, we're actually going to go through my 5-point investment checklist. So the 5 points that I look at when I'm investing in any company. And so we're going to go through that together. And it's going to be really interesting to see how a company like Vulcan might stack up against that. Obviously, if you vote on the company, it looks like which company you want me to cover, it looks like Netflix is right up there. So jump into the chat. Netflix at 38%. Looks like it's going to take the goods here in terms of what I'm going to cover next week. But what I'll be doing next week is actually taking you through my 5-step checklist to analyze any company like Vulcan. Okay, so Slimy says, I do not like the way VUL divulged. Kunico seems like they gave away something shareholders owned and wanted shareholders to pay for it. I don't know much about this, Slimy, so if you want to chuck any comments in the chat there, please go right ahead. So Alex said, I think Amazon would be a very interesting one considering how they have had good results and reporting, but haven't had much movement. Yeah, let's have a quick look at that. So here we go, Amazon. Let's have a look at the stock over in here. We can see the share price. Yeah, Amazon, obviously one of the greatest success stories in modern times for investors, has just chugged along. It's obviously an enormous company now. You can see here 1.6 billion US market cap. So it's a massive company. Revenues of 386 billion. Keep in mind that Amazon makes a very high revenue amount of revenue, but the real secret sauce inside Amazon, in my opinion, is actually its AWS business. It's no secret. I think most of you who have invested in Amazon shares, I don't own Amazon shares, but if you do, you'd know that AWS, which is their cloud computing environment, is actually an enormous opportunity and it's still growing. I've heard some rumors that cloud computing could be a $1 trillion industry. So even if AWS from Amazon doesn't win, which it looks like it might, there's Microsoft Azure, Amazon AWS, Google GCP, and then there's some Chinese companies like Alibaba that are trying to break into the space, as well as Oracle Cloud. But yeah, it's a really interesting one. David Palucci asks, are you open to looking at a microcap? David, I absolutely love microcaps. If you know me from the Investors Podcast, or you know me from anywhere that I tend to dwell, like over on our website, you will know that I love microcaps. So chuck me a recommendation. Make it a good one. Make it a company that's reasonable. Last week I talked about AMS, which was this business. So I talked about Atomos, which is this business right here. If you want to jump into the chat again, David, and just give me a name, ID8, Identity. Okay, ID8. Let's have a look at this. ID8. Interesting, up 10% today. Fantastic. Revenues of $2 million. So this is small. Australian-based software company, enterprise software products for the financial services industry. Oh, actually, I have heard about this, David. This is not a company that I follow really closely, but here we go. Okay, so it is really small, so keep that in mind, guys. This would be one that you'd have to put on your watch list because it is very small. So I've got to be careful here in terms of what I say, but it's obviously still loss-making. Some of the things that you could look for in small companies are that cash flow. You want to see cash flow going up. This is only a one-page document. So here we'll go back to the latest quarterly report. One of the things that I think de-risks a lot of small cap investing is actually making sure that it makes a lot of cash flow. And so we can see here that they've actually only got $86,000 of quarterly cash flows, and yet they're spending $613,000 on research and development, and staff costs alone are $900,000, admin costs $506,000. So they're actually using cash. Now, cash isn't always a bad thing when it's being used, but you've got to know where it's going and why it's going. So take a look. They have a global payment for the SWIFT network rail. Interesting, David. So how about the medical marijuana in AU? Cameron asks. Yeah, I mean, there are a lot of companies, so that's definitely something we could look at, like NXL or CAN. Yep, cool. So let's have a look at something else. That's a good, interesting business. Drop it in the chat there, David, if you want to let us know what the you said global SWIFT network, which is a payment network. Please jump in the chat and let us know why you like it. Check out the chart. Okay, check out the chart, he says. Let's have a look. Oh, yeah, so it actually has gone up quite a bit recently, but be mindful, as always. Yeah, right, okay, so it looks like this is on a 10-year basis. Let's zoom into 1 year. Okay, it's come down pretty hard, and it's come back up recently. So T3T, interesting company that you've said, 4DX. Now, I've got to be honest with you, T3T, I don't own 4D Medical, but I've actually come across a lot of people that do seem to like it. So one of the things that I want to I'll just point out right now is it's actually one thing I like to do when I think about management is I often do things like Google the people that are responsible for the business. So if we go into where are we? Why can't I see this? Investor information. Let's see if we can go here. Okay. Oh, here it is. This is what I wanted. It'd be good if I knew how to use a computer. Okay, so one of the things that I like to do, especially for small caps, is understand who's in charge of the business and what are they up to. Now, one of the things that I know from 40X Medical is that Dr. Sam Hupert here is one of the advisors to the board. Now, some of you might know Dr. Sam Hupert because Dr. Sam Hupert is actually the co-founder of Pro Medicus, and Pro Medicus is one of the ASX's best performing companies of, I would say, the past 10 years. So what I like to do is, Slimemeat says 40X is on a winner with its lung and circulatory analysis. Will be in high demand for all those who have contracted COVID. Fascinating analysis there. So Pro Medicus is one of those businesses which I know that Slimemeat knows as well. And you can see that the business has performed very well. Really interesting. Oh, thanks for getting back to me, David. You said, so for identity, it has broken a 200-day moving average. They're currently selling a RegTech product to all the banks in Australia. Just signed up Citibank on a trial. Every bank needs to report IFTI transactions. Cool. Interesting. So that's wonderful to know. Chanda S asks, how do you go about running a scan to search stocks in SelfWealth using specific parameters such as PE, ROE, market cap, etc.? That's actually something that we could probably go through next week when we talk about how to find companies, because that's actually something really interesting that I want to get to as part of my 5-point checklist. So we can go over that a bit next week. I've actually got a few. Oh, here we go. Can we look at OML, another one undervalued during COVID? OML. Media, really interesting one here from Warrior. Media does a lot of outdoor advertising and digital billboards, which is really interesting business because obviously COVID has really hurt the business. Not many people out on the road and doing these types of things. So this would be the type of business that I would want to make sure that I do a solid amount of research into before I even go close to it. The reason being, Warrior, is that it's really important that you understand what impact COVID has had on the business from a financial perspective. So from debt, from its cash flow perspective, from all of those different things, just have a really good grounding on it. You can see that the half-year report came out recently. So what do I mean by when you look at the cash flows? So here we can see revenue up, and I'll zoom in a bit here so we can actually see what on earth is going on. So revenue increased 22%, which is an interesting sign, but the loss and the loss actually was better than last year at negative 9.3 million. Pardon me. If we come down, what was I talking about before when I talk about cash flows? So most of our valuations, when it comes through to investing as analysts, what we look at is and I went over this last week as a rule of thumb, is look at the operating activities. So this number right here, let's try and bring that up even a little bit more here. Look at this net cash generated in operating activities. First of all, you want this to be positive because this means from all of the operations, it's actually positive. So up, that's positive $81 million. Really interesting. And then we've got, look at the investments that it's making for its future. And that's this metric down the bottom here. So you can see that here, negative $8 million. And you can see the cash flows. If we take this 81 million, so let's take 81,439 minus 8029 equals 73,410. And so that actually shows you, if you get this less that, it actually shows you that the business is actually generating cash flows, which is super important, especially for businesses like Media, which does advertising and billboards and such. You need to make sure that it's actually, a sustainable business model. Okay, so there were a couple of other things that I wanted to go over with you today. One of the questions that we had last week was around about GameStop, which is a really popular stock, which we know is really popular on the platform because a lot of people in the community have wanted to buy it, which we fully appreciate. I was speaking to the SelfWealth team, and we know it's really popular in the community. you can see here that most people are buying it because they've got a good tip. My wife was actually on the SelfWealth platform the other night buying shares for the first time, and she selected this option. She didn't buy GameStop; she bought something else. And I thought this is funny because she said that sounds like about right. My husband, i.e., me, is actually the one that does most of the investing in our household, and she said, "Oh, well, you're giving me a tip, so I'll just click this option here." You can see that most people buy it for this reason, and most people sell it for this reason. On the financial side, one of the things that I like to look at, and for those of you who don't know, GameStop is one of those so-called air quotes meme stocks, and what was actually really interesting about GameStop is it just blew up. So that's probably the way to talk about it. You can see here that it actually just went kind of crazy last year because of a few of the Wall Street bets, Reddit in the USA. Investors really got behind it, and traders too, and wanted to kind of hurt the short sellers. But if you ask me, if we come to the financials, what I like to look at is I like to see growth businesses. So GameStop actually sells. It does distribution for games and that type of stuff. So think of like EB Games at your local shopping center, which is being rebranded in some parts of the world. If we look at two things like revenue and gross profit, we can see both of those things have been declining in recent years. They've actually done some really interesting things in terms of bringing new products to market. But I just want to call out that for me personally, this is not the type of business that I like to invest in because I like to see growth over the long term. So, I'm not saying that this is for everyone or isn't for everyone. It's just for me saying that it's not the type of business that I like to invest in. I like to invest in businesses that are very wide and strong moats rather than anything else. So, so here we go. JN says all shares are basically bullish. Yeah, so you can see here the community sentiment bullish on GameStop. One of the things is, guys, right, is that when you think about investing, your job isn't always to agree with what everyone says. So even though you might see this here, it's not always to agree. Sometimes, you've got to do something different. You've got to have a variant perception, which is what we call it in analyst land, to come up with something and to have an opinion. So just another final reminder, guys, that anything here that we say is limited to general financial advice only. I've had heaps of fun talking about these stocks today, but keep in mind that, I'm only one investor, and this is just me coming out here and just having a bit of time trying to educate everyone on some businesses. So we're coming to the end of the chat now. Thank you so much to everyone that joined us today. This was a bit of fun. What we're really interested to do is kind of bring the engagement back to SelfWealth, just really get you in here and have a conversation with me. If you have any questions for next week, you can still drop them into the chat. Just drop them in here. So Cameron asks, what is it like to work in investing during massive market changes like the COVID pandemic? Well, there are two things that I remember from COVID, Cameron. The first is that everyone lost their marbles. They went crazy. And there are two people that are in the share market. The first person is the person that runs towards the chaos, and the other person is the person that runs away. We all say we're high risk, high growth investors until the next market crash. Personally, I loved the COVID pandemic because I'd done all my research. I'd used my tools. I've done my modeling. And then during COVID, I was ready to buy shares. And I was looking at these wonderful companies like Square, like Apple, like Google, all of these wonderful companies, even here in Australia, EML Payments, Xero, all these companies got sold off. It was like Christmas. So I was loving that. Okay, so there's been some great stuff today, guys. I really enjoyed it. I'm glad we managed to get into the platform and have a look around. Remember, you can watch this on replay, and we've still got another 4 weeks together. So I'll be here for 4 weeks. You can find all of the videos on the SelfWealth YouTube channel. You can find them on the blog section of the page. Just click media on the homepage there. You can ask us questions on social media by going to #SelfWealthLive on Facebook, Instagram, or Twitter. And you can find me on Twitter as well. So much fun. I love it, guys. Thank you so much for joining in. Thanks for focusing on long-term investing, and I look forward to seeing you next week. So once again, thank you so much, and stay safe, invest well, onwards and upwards.